DeFi, it's wild out there. The world of finance is changing, fast, like really fast. Decentralized finance, or DeFi, is shaking things up. It's exciting, confusing, and potentially revolutionary. Think of it like the early days of the internet, full of promise, but also a lot of weirdness. Remember when everyone was talking about Bitcoin? DeFi is like Bitcoin's cooler, more complex cousin. It's not just about digital money, it's about reinventing the entire financial system. Buckle up because things are about to get interesting. So what exactly is DeFi? In a nutshell, it's about taking the traditional financial system, banks, loans, investments, and making it decentralized. Instead of relying on middlemen like banks, DeFi uses blockchain technology and smart contracts to cut out the intermediaries. Think of it like this. Imagine getting a loan directly from a friend, but instead of your friend, it's a global network of computers. That's the basic idea behind DeFi lending. It's peer-to-peer finance, but on a whole new level. DeFi aims to give you more control over your money. No more bank fees, no more waiting for transactions to clear. It's finance, but faster, cheaper, and, supposedly, more transparent. Of course, there's a catch. Actually, there are several. The potential benefits of DeFi are pretty mind-blowing. For starters, it could give people around the world access to financial services they've never had before. No bank account? No problem. DeFi doesn't discriminate. Imagine a world where you can send money to anyone instantly, regardless of where they live, or where you can borrow and lend money without needing a credit score. That's the utopian vision of DeFi. But let's not get ahead of ourselves. DeFi is still in its early stages, and there are a lot of kinks to work out. Remember, the internet was pretty clunky back in the day too. Section 4, How DeFi Actually Works. It's like explaining the internet in 1995. Okay, here's where things get a little technical. DeFi relies on three main building blocks: cryptocurrencies, smart contracts, and decentralized exchanges. Cryptocurrencies like Bitcoin and Ethereum are the lifeblood of the DeFi ecosystem. They're used to make transactions, pay fees, and provide collateral for loans. Think of them as the fuel that powers the DeFi engine. Smart contracts are basically self-executing contracts that automate transactions and enforce agreements. They're like digital vending machines for financial services. You put in your crypto, the contract does its thing, and you get what you paid for. Decentralized exchanges, or DEX, are like cryptocurrency marketplaces where you can trade one digital asset for another. They're like the stock market, but without the brokers and middlemen. It's all about cutting out the intermediaries and giving you more control. Section 5, the DeFi danger zone, volatility, hacks, and the feds. Now for the reality check. DeFi is still a bit of a wild west, and there are some serious risks to consider. First and foremost, the cryptocurrency market is notoriously volatile. Your investments can go up, but they can also go down, and sometimes they can go down a lot. Then there's the issue of security. DeFi platforms are often targeted by hackers, and if they manage to exploit a vulnerability, you could lose everything. Remember, there's no insurance in the decentralized world. And let's not forget about the regulators. Governments around the world are still trying to figure out how to deal with DeFi, and there's a good chance they'll eventually crack down with rules and regulations. So, is DeFi the future of finance? Maybe. It has the potential to revolutionize the way we think about money, but it also comes with its fair share of risks. Proceed with caution, do your research, and remember, never invest more than you can afford to lose.